Namaste everyone. I introduced to my topic for RPP, options market. Now what are options? An option is a contract that gives the buyer the right but not the obligation to buy or sell an underlying asset at a specific rate on or before a certain date. An option, just like a stock or bond, is a security. It is also a binding contract with strictly defined terms and properties. Now let us have an example. That you discover a house that you would love to purchase. Unfortunately, you won't have the cash to buy it for the next 3 months. You talk to the owner and negotiate a deal that gives you an option to buy the house in 3 months for a price of Rs 2 lakh. The owner agrees, but for this option, you pay a price for Rs 25,000. Now get familiar with the terminology of the example. Underlying asset, house, stock price, Rs 2 lakh, expiration date, on the day after the expiration time period, which is of 3 months. Premium, the amount paid by you of Rs 25,000 for the option contract. It's discovered that a celebrity in the neighborhood is none other than Ranbir Kapoor. Now, the sound of that gave me chills. Stock price rises up to 8 lakh. Because the owner sold you the option, he is obligated to sell you the house for Rs 2 lakh and not Rs 8 lakh, which is the current market value of the house. In the end, you stand to make a profit of Rs 5 lakh 75,000, which comes from Rs 8 lakh minus Rs 2 lakh minus Rs 25,000, which is the premium given by you. But while touring the house, you discover not only that the walls are chock full of asbestos, furthermore, a family of super intelligent rats have built a fortress in the basement. Though you originally thought you had found the house of your dreams, you now consider it worthless. On the upside, because you bought an option, you are under no obligation to go through the sale. Of course, you will lose the Rs 25,000 price of the option, which was the premium given by you. These examples demonstrate two very important points. First, when you buy an option, you have a right but not an obligation to do something. You can always let the expiration date go by, at which point the option becomes worthless. If this happens, you lose 100% of your investment, which is the money you used to pay for the option. Second, an option is merely a contract that deals with an underlying asset. For this reason, options are called derivatives, which means an option derives its value from something else. In our example, the house is the underlying asset. Most of the time, the underlying asset is a stock or an index. The two types of options are calls and put. We will mainly focus on call option. What are call options? A call gives the holder the right to buy an asset at a certain price within a specified period of time. Buyers of call hope that the stock will increase substantially before the option expires. Now let us consider a hypothetical example. Mr. Roy makes a contract of a laptop of Rs 20,000 with Mr. Kapoor for a period of 3 months of a September 40,000 call by giving a premium of Rs 8,000. Now let us see what happens after 3 months. Rise in the price of the laptop. After 3 months, the price rises up to Rs 60,000. Now Mr. Roy has to pay only Rs 20,000 because of the obligation by Mr. Kapoor, and the profit is Rs 32,000, which is 60,000 minus 20,000 minus 8,000, which is the premium. But there can also be a possibility that there is a fall in the price of a laptop. Price after 3 months, Rs 25,000, which is less than 40,000. So, the contract is cancelled as the price falls below Rs 40,000. and the loss is rupees 8,000, which was the premium. Now, what are put options? A put gives the holder the right to sell an asset at a certain price within a specific period of time. Buyers of puts hope that the price of the stock will fall before the option expires. Now, the contradictory to that is the put option. When the price of the security decreases which you have purchased below the estimated price, then in that case your put option gains value, and that is the time when the buyer of the put option gets his returns. Why use options? There are three main reasons for using options. They are speculation, hedging, and stock options. Now let us consider each of them separately. Speculation. You can think of speculation as betting on the movement of a security. The advantage of options is that you are not limited to making a profit only when the market goes up. Because of the versatility of the options, you can also make money when the market goes down or even sideways. Speculation is the territory in which the big money is made and also lost. The use of options in this manner is the reason options have the reputation of being risky. This is because when you buy an option, you have to be correct in determining not only the direction of the stock movement but also the magnitude and the timing of this movement. To succeed, you must correctly predict whether a stock will go up or down, and you have to be right about how much the price will change as well as the time frame it will take for all this to happen. And don't forget about the commissions. The combination of these factors means the odds are stacked against you. So why do people speculate with options if the odds are so skewed? Aside from its versatility, it's all about using leverage. When you are controlling 100 shares with one contract, it doesn't take much of a price movement to generate substantial profits. Hedging. Hedging is a risk management strategy used in limiting or offsetting probability of loss from fluctuations in the price of commodities, currencies, or securities. In fact, hedging is a transfer of risk without buying insurance policies. Stock options. Many companies use stock options as a way to attract and to keep talented employees, especially management. They are similar to regular stock options in that the holder has a right but not the obligation to purchase company stock. Risk factor. This versatility, however, does not come without its cost. Options are complex securities and can be extremely risky. This is why, when trading options, you'll see a disclaimer like the following. Options involve risk and are not suitable for everyone. Option trading can be speculative in nature and carries substantial risk of loss. Only invest on your own risk. Despite what anybody tells you, option trading involves risk, especially if you don't know what you are doing. Because of this, many people suggest you steer clear of options and forget their existence. On the other hand, being ignorant of any type of investment places you in a weak position. So if you know how to deal with options, you should definitely invest in options. 9/11 is considered to be one of the most uneventful days in the history of America and also the world. Loss. You can see that the stock prices of the United Airlines and the American Airlines have gone drastically down after the day. Profiting from a loss. Over 3 days before terrorists flattened the World Trade Center and damaged the Pentagon, there was more than 25 times the previous daily average trading in a Morgan Stanley put option that makes money when shares fall below $45. Trading in similar AMR and UAL put options which make money when their stocks fall below $30 a piece surged to as much as 2285 times the average trading up to that time. On September 6 and 7, when there was no significant news or stock price movement involving United, the Chicago Exchange handled 4,074 put options for UAL stock compared with just 396 call options. Essentially, bets that price will rise. On September 10, an uneventful day for America, the volume was 748 calls and 4,516 puts, based on a check of option trading records. In the case of insurance companies, several companies in the insurance business were expected to suffer huge losses from the attack. Munich Republic of Germany and Swiss Republic of Switzerland, the world's two biggest reinsurers, and not to forget the AXA Group of France. Trading in shares of Munich Republic was almost double its normal level on September 6 and 7, and trading in the shares of Swiss Republic was more than double its normal level on September 7.
Hi, I'm Rick Swope. Let me ask you a question. How do you make money in the stock market? Most people will answer buy low and sell high. One of the greatest benefits of options trading is that you can create a strategy for any market condition, up, down, or sideways. If you think a stock is going to go up, you can buy a call option that will go up with the price of the stock. If you think prices are going to drop, there are put options that increase in value as the price of the stock moves lower. It's all a little bit like a chess game, where your challenge is to decide what direction you think the market will move. But before you make that first move, you need to know some of the basics. First, options are sold in contracts, and the price of an option contract is called the premium. That's how much you'll have to pay for each option contract. Secondly, options are also priced as a fraction of the cost of the stock. For example, suppose the premium you pay for an option contract is $20 per share, when the price of the stock is trading for $100 per share. You can buy options that are called calls that act very much like the stock. If the price of the stock moves up, the value of the call will generally increase with the price of the stock. Should the price go down, the value of that option contract will drop. In our example, instead of putting $100 at risk per share, you only have to put $20 at risk per share through the option contract you buy. The lower cost may help you reduce your risk to the downside should the stock move against you. However, if you think the price of the stock will go down, you can buy a put option, which generally moves in the opposite direction of your stock. As an option trader, you'll have to be disciplined with your approach to risk management. After all, options were originally created as risk management tools. Even if you're new to options trading, I'm sure you can appreciate the value of that protection. Remember, there are plenty of option strategies, some more conservative than others. In fact, many of them can be used by investors in their retirement accounts. As you've heard in this brief overview, there are option strategies for virtually every kind of market. The key is to find the option strategy that's right for you. And this video is just the beginning. I'm Rick Swope. Thank you for watching.
Thank you.